Hello guys. In this video I'll try to focus on something very specific in investing or trading. Is the same thing, like what I'm trying to do is speaking about investing in ETFs. ETFs are exchange traded funds. What does it mean? An ETF, it is like a stock that tracks an index. Whatever index is a general index like the Dow Jones, 30 companies. You can track them with a kind of ETF which is like a stock. You can buy it, you can sell it. It's not like a mutual fund. A mutual fund, there should be a procedure to buy and to sell mutual funds, but ETFs are easier because it is like a stock. When you see it on the, for example, you see it in the chart, it is like a stock and you can buy it. You put just a simple, for example, if you want to buy the Dow Jones 30 stocks industrial average, so it's called DJIA. This is the symbol of the index of the ETF. You put this ETF and you buy 100 shares or 200 or 50 shares, whatever you want. Now, what is the good thing about the index, about this ETF? It tracks the whole index of stocks. Okay, if you want, for example, to track the S&P 500 stocks, so this index, you can just find the ETF, okay, and you buy it. It is as if you bought 500 stocks. Now, if you want, for example, to have the small companies or medium companies like the Russell 2000, which is a small companies, you want to buy this, let's say, 2,000 stocks, you can buy them. Although you don't have money, but you buy the index ETF. That follows, that tracks this, and this is a good way for those who want to invest for the long run. Okay, you can buy. There are a lot of these ETFs. They are like stocks. Okay, you will find hundreds. If you go to the chart that I'm using, which is the free stockcharts.com, you will find ETFs that we have a lot. So it will be very difficult in order to choose one of them. But if you are interested, you can study them and you can do my strategy. It means training level 2, how to search for stocks using Stock Scanner. You can find ETFs like this because it is written when it is an ETF. Okay, so you just focus on the ETFs and don't look at those the other stocks. Because you are looking to invest for the long run. You are not so. And another good thing, you don't put stop loss. Okay, because you buy this kind of ETFs in order to stay long in the market. And this is how things work with the ETF. And the fees are, most of the ETFs are less than $1. 1%. It means you find it 50 cents percent. It means 0.50 percent, which is the fee is too small. Okay, because you understand that you can't buy 30 stocks or 50 stocks or 100 stocks. Okay, it's too much for you, so you can just buy the index, which is the ETF, which is so simple. You just try to see, for example, you like an industry and you see it's going up, you just go the ETF, you find the ETF of this industry and you buy it. And you leave it for 1 year or 2 or 3, and you will see the result in the chart. If that industry is going up, you will be making money. Okay? And this is how some people, they invest. They don't buy mutual funds because most of the mutual funds, the fees are higher and higher. And there is the procedure to buy and to sell is a little bit difficult. So some investors, they go and they buy these ETFs, which are like stocks. You go to your broker, you put the symbol of the index. If you don't know, you know the index name, so you just ask your broker. You say, oh, hello. You say, hi, I want the index ETF of this index. You give him the name of the index. He will just in a few seconds, he will give you the name and the symbol. You put the symbol and you make sure that it is the because it will be written it is an ETF and what is it, and then you can buy it and leave it in your account. Okay, so there is a little little fees now, and in terms of risk, you have less risk. But I'm telling you, if you buy stocks, the risk is so high. That's why a lot of people, they don't like to buy stocks, because it is so high risk. You buy a stock at $60 and after 2 years or 3 it goes to 30 or to 20, you will be losing a lot of money. Okay, but for in ETFs and what we call ETFs, you can just check. It's like a stock. You can get rid of it as soon as you see that it is too much for you in terms of risk. You can put your risk criteria and you can follow them. The good thing also is that you don't put stop loss, because you don't want to exit early. You want to see 1 year and then you see how your selection works, because you can't see in 1 day or 2 or 3 you buy an ETF and then you wait 1 week or 2 and then you see the result. You can't, because you are not doing swing trading. You are doing investing. Investing, as I told you before, it's 1 year and more. Now in swing trading, it's only 1 day, a few days, few weeks, 1 month or 2 or 6, depending on the stock, if it still gives you money. Okay, so hope this explanation clarifies a lot of ideas that you have in mind. If you have more questions, please comment on this section, or if you have a question, please here is my email. Send me the private email. Email here is on the top of the description. Send me an email and I will answer on time. Thank you very much and have a nice day.